Welcome everyone. My name is Patrick Bumming. I work for the German-Irish Chamber of Industry and Commerce, and I work for the International, which is a service section of the German-Irish Chamber of Industry and Commerce. The German-Irish Chamber of Industry and Commerce is divided into three pillars. One is membership. We have more than 300 members. One is official trade representative of the German economy in Ireland. That's our CEO. And then the other one is the International, where we assist German companies coming to Ireland and Irish companies going to Germany and worldwide to open doors to help them enter the other market. We have more than 130 offices in more than 80 countries, and therefore we can assist Irish companies going worldwide. During this talk, I will give an overview of the main tax sets which are relevant when companies come for temporary contracts to Ireland, and I will focus on Ireland and Germany, because I will go from slide to slide. You will see the Irish slides with a picture of the spire and the GPO, and the German slides will have the TV tower of Düsseldorf, which is the equivalent of the spire. I will focus on these topics in two countries. When I did my tax exams, I would have wished that I could have covered these topics within 15 minutes, so it's really only a whistle-stop tour to give you an overview. I first start with relevant contract tax, because that's a very important issue for companies from Germany and other countries to come to Ireland, and it has significant cash flow implications for them. On the one hand, because of the tax which is deducted, on the other hand, for penalties. If non-resident companies come to Ireland and they work here for Irish companies and they don't have an Irish tax number, 35% have to be deducted and paid to the Irish revenue. If they have an Irish tax number, it's 20%, and they can also apply for an exemption. However, revenue has very strict penalties on if payments aren't notified on time, which means aren't notified on the revenue online system before they are paid. And there's a mistake on the slide. The penalties are between 3 and 35%. So for example, if a company comes to Ireland, is working for an Irish company, the Irish company pays 100% to the company, didn't notify revenue, the company didn't have an Irish tax number, penalty of 35% could apply, which is of course means instead of 100% they have to pay 135%, and that's with the employer. What is the challenge for German companies or other companies? They often come to Ireland, are working here, and they're also working in other countries. And the people who are dealing with the invoices in Germany don't really know where the invoices come from, because there might be only a very small line on it saying Dublin construction site. They pay 100%. Afterwards they are told, oh, you should have deducted 35% relevant contract tax, which means this German company has to pay then again 135% because it didn't know about it, and because maybe the people in the German office didn't even speak English. Therefore it's very important that when Irish companies work with non-resident companies, that the invoices are marked correctly, that RCT applies. On the other hand, why is this important for Irish companies? If an Irish company is employed by a German company, for example, a German company is building a house and they are employing a crane hire company, and the crane hire company is looking for the money, the German company has to be registered online with Revenue Online in order to notify revenue of the payments. This takes a while, and therefore if an Irish company is employed by a German company, it's well advised that they tell them about RCT, because then otherwise when it comes to payments there might be a significant delay. Now here you see Germany. Germany also has a construction withholding tax. It's 15% only. The penalties regime isn't that strictly enforced as in Ireland, and a 0% is much easier to obtain. However, if a company is working in Germany and RCT is deducted, it usually takes a year till it's paid back. Now I'll come to VAT. Usually work on immovable property is subject to VAT in the country where the immovable property is, which means with construction operations, VAT has to be paid in the country where the construction site is. However, once the contract is subject to RCT, the reverse charge procedure applies, which means that no VAT has to be charged, but the principal has to self-account for the VAT, so basically no money is flowing, but revenue is notified of the payments. Revenue is at the moment focusing on the construction industry and has notified that there are a lot of mistakes done with this reverse charge procedure. On the one hand, that there's no indication on the invoice that the reverse charge applies, and that it's not correctly accounted for in the VAT tree form. Coming back to Germany, the German VAT rate is 19%. Germany has a similar system to Ireland with a reverse charge where construction operations are. It's called 13B procedure. And if an Irish company is working in Germany and they don't have to register for VAT, it might be still very useful for them to apply for a refund, because in Germany you get VAT back on a lot of expenses where you wouldn't get it back in Ireland, like for example accommodation, car hire and fuel. We have a lot of German companies who come here, ask, will I register for VAT? And if they just have these expenses and they don't have to register for VAT, often they don't do it because they don't get the VAT back anyway. However, Irish companies in Germany would get that VAT back. However, the deadline for this is the 30th of September of the following year, and if you don't apply for the refund by then, the money is lost. Coming to corporation tax, the double taxation agreement between Germany and Ireland and also other countries sets out when a company has a permanent establishment in Ireland. The German-Irish tax agreement says it's 12 months for a site, but that varies from country to country. For example, with the UK it's 6 months. And if you and it doesn't mean that if you are here less than 12 months that you don't have a permanent establishment. For example, if you have an office here, a factory, you will have a permanent establishment, and also if the contracts are concluded. There's a significant list in the DTA which sets out when a permanent establishment is created. Coming back to Germany, Germany has a corporation tax rate of 15%. A lot of people might wonder, why is it 15%, Ireland's 12.5%, and there's so much correspondence about the Irish rate. Germany has an additional tax which is called trade tax, Gewerbesteuer, which is between 5 and 15%, and that comes on top of it. It's usually very high in city center areas. There it's more on the 25% rate. In rural areas it's on the 5% rate, and that's why a lot of German big companies have their head office registered in a small rural area in order to save on the tax. However, like with Irish corporation tax, there are similar rules regarding tax evasion. And another point is here, when a company, for example, has a permanent establishment in Germany for corporation tax, it still has to look at where's the permanent establishment for trade tax, especially for construction companies when they go from site to site. In Ireland, if employees are sent to Ireland, there's the double taxation agreement sets out, if the company doesn't have a permanent establishment here, that unless they are less than 183 days here, no payroll taxes have to be deducted, no PAYE. However, Ireland has a rule, a 60-day rule, which doesn't exist in that equivalent in other countries, which says that if you work between 60 and 183 days, you have to notify revenue and apply for an exemption after 21 days of start. A lot of German companies don't do that, and if they don't apply for that, it could mean that they have to pay payroll taxes in Germany and in Ireland, which brings a lot of extra administration effort and also cash flow effort, because taxes have to be paid in two countries. Country money subsistence rate, also a challenge in Ireland. Coming back to the GPO, the country money is measured from where your work, how far your site is away from the GPO, which rate applies. In general, it's about 180 euro a week, which can be tax-free to employees for subsistence. German companies usually have a much higher subsistence rate, which means people who come to Ireland for temporary contracts, it can be quite good for them because they get paid a lot of money tax-free because they are working in a different country. However, if they are subject to Irish PAYE, it means that part of the subsistence rate has to be taxed, which of course brings in lower net income and a higher tax burden for the Irish company, for the German. Another very important thing is, which is very easily obtained, is a Form A1, and that's European-wide, also for non-resident companies coming to Ireland. The Form A1 is a form which is issued by the Department of Social and Family Affairs, and if PRSI has been paid for a certain time for an employee. And if you have that form, you don't have to pay PRSI if you're working in another country. However, if you don't have that form, it means you have to pay PRSI from the first day. And in Germany, the social contributions are much higher than in Ireland. They are for the employee and employer between 19 to 20%. In Ireland, they are 4 and 10.75, which means, of course, if it's just forgotten to get this form, and PRSI has to be paid in both countries, it mightn't be really that beneficial for the employee, and it means a high tax burden or PRSI burden. And also, when the German customs audit construction sites in Germany, that's the first thing they are looking for the Form A1. Then if you become liable in Germany for taxes, for example, if you have a permanent establishment or your people are more there for 183 days, there's a church tax, which varies from county to county. You can opt out by simply clicking that you don't belong to a church, so that's up to your own faith. And an example that taxes usually are not abolished is the unification tax, which was introduced 25 years ago when Germany got reunited. It was supposed to be a temporary tax. However, it still exists and will stay in existence. It's June, it's holiday time. German people are, like Irish people, known for working hard. However, Germany is very keen that if foreign employees work in Ireland, that they have the same holiday entitlement than German construction workers. And therefore they introduced Sokabau, which means Sozialkasse Bau. It's a holiday fund, and 14 to 15% for the employee have to be refunded. If the employee at the end of the year states that he got all his holiday, it will be paid back. But often, if the employer pays it, and he's looking for a refund at the end of the year, there might be difficulties if the employee has left the company since. Sokabau has been criticized because it's a specific German rule. Companies go to Germany, don't know about it, operate without it, and then they're surprised when they get hefty penalty letters. If employees are sent to Germany, also the German customs has to be notified before the employees are going to Germany, which means a list of the employees with the site etc. has to be given to, and often after this notification an audit will be carried out on the site. And the German customs also notifies Sokabau. So for example, if you notify customs that you're going to Germany but not notify Sokabau, it's pretty likely that you get a letter straight away from Sokabau asking for registration. The construction definition of Sokabau is not as wide as it would be in Ireland, so a lot of companies who only, for example, go over for supervisory work, it's very beneficial for them if they register with Sokabau and then they get an exemption because their work wouldn't fall into the definition of construction work. They have a list on it, what is construction work, and it's really only classical construction work. And if a company is carrying out craft work, it might have to register with the local chamber of crafts. Safety is a big issue in Ireland and in Germany. And one issue most companies know in Ireland very well about is the Safe Pass. However, a lot of companies who come to Ireland don't know about it, and they think that the 3 years their employees did an internship is sufficient about it, and that the other international certifications they have. And they come to Ireland to start to work, and they don't know that they have to do a Safe Pass, which leads to a delay because there's a 10-day notice period for a Safe Pass, and at least 8 people of the same language have to take part in the Safe Pass course. Which means, for example, if you're coming to Ireland with 4 Romanian or German-speaking staff, you want to start working straight away, you're told, sorry, you have to organize a Safe Pass course. That takes 10 days, and then you're told, and you need 8 people, which often you can't supply. So that is a challenge, and can lead to a lot of delays and a lot of costs. And if you engage foreign subcontractors, I always advise that you talk to them about that before. That's the end of my presentation. At the end, I said it's a whistle-stop tool. I only touched on the topics very briefly, so you're welcome to ask me questions now or send me an email to my email address which you have there. Thank you very much.